U.S. stocks are on pace for their worst month since the financial crisis of 2008. But is now time to be fearful, or is there a great buying opportunity ahead?
The heavy selling continued last week, with the Dow Jones down just under 3%, the S&P 500, the NASDAQ, and the Russell 2000 were all down just under 4%. Now, last week's video, all four of these US indexes were positive, but now we see three of these four indexes negative, with the NASDAQ still up about 4%, but the big story is the Russell 2000, which was a leader at the beginning of the year, is now the lagger, down over 3% year to date. Foreign and emerging markets were also negative last week, with both down around 3%, and now foreign and emerging market stocks are both down double digits for the year. We've talked a lot over the last couple weeks about the S&P 500 and the 200-day moving average. Now, if you're not familiar with what the 200-day moving average is, it's an indicator that if we're above this level, we're bullish on the market, but if we're below the 200-day moving average, could be a bearish signal for the market. Now, two things happened in the markets last week. First, the S&P 500 dropped below the 200-day moving average and stayed there. Second, the 200-day moving average went from a 607-day uptrend to appearing like it's on a downtrend now. And both of these things are bearish for the market. This 607-day uptrend in the 200-day moving average has actually been the sixth longest in the stock market's history. Now, we're paying attention closely this week to see if these negative trends continue or if we can see a nice bounce in the US markets.
Although many of the technical indicators for the stock market are flashing bearish signals, I wanted to take a look at the underlying fundamentals of the economy along with some of the numbers that were being reported last week to see if they paint a different picture. First, I wanted to look at GDP, which was reported last week, and the numbers came in at 3.5% growth rate. And if you combined this quarter with the last quarter, this is the largest growth we've seen since 2005. But as we mentioned last week, the key numbers that we were looking for inside of the GDP report was the inflation data. And the central bank was expecting 2% inflation growth over the last quarter. And those numbers came in under expectation at 1.6%. So that's positive news for anyone that was hoping to see the Federal Reserve slow down their rate hikes. The next thing that I would like to cover is earnings from the third quarter so far. And 78% of companies have beat their expectation. And it was estimated that companies were going to grow at over 22% year over year, but the numbers are coming in even better than that, at over 25%. So these great earning numbers, combined with the market sell-off, is showing a very similar setup to what we've seen during the market correction of early 2016. Lastly, since World War II, we've seen 18 midterm elections, and the S&P 500 has rallied off of its October lows all 18 times, with an average return of over 10%.
Even with all the strong economic data that Matt mentioned, the US markets are still below their 200-day moving averages, which has historically been a bearish signal.
Thanks for watching, and we strive to give you everything that you need to know about the markets in 5 minutes or less.
Like our Facebook page and share our video. Thanks a lot.